Welcome back everyone, I'm Tanuja Yadav and today I'm going to present to you the fifth video in the series of Let's Invest. Today I'm going to talk about assessing your risk profile. When we talk about risk profile, the first word that comes to our mind is risk tolerance. Risk tolerance is made up of two components, your willingness to take risk and your ability to take risk. Willingness to take risk again comes from either your knowledge about financial markets or your knowledge about the financial instruments in which you are willing to invest, or it can come from the answers that you take to the survey. So you will get a result at the end of the survey which will tell you what is your risk tolerance. Ability to take risk comes from a secure job, it comes from high income relative to your expenses, it comes from owning a lot of assets and also from a longer time horizon if you have more than 20 years for keeping with investments. You can easily assess your risk-taking ability by using one of these links mentioned here. The quiz does not take more than 10 to 15 minutes, but it will tell you what is your risk profile. The outcome of this risk assessment survey will tell whether you are an aggressive investor or a conservative investor. It may also tell you whether you have high risk tolerance or low risk tolerance. If you have low risk tolerance, you will fall under this category. That is, your primary objective is capital preservation. You are not comfortable with losing value on your investment, but you very well understand that low risk investment also means low return investments. On the other extreme, you have high risk tolerance. High risk tolerance means that you are an aggressive investor. You are comfortable with taking a lot of risk, and because you know that it may generate very high returns in the future. It also means that you have the ability to absorb large losses because it may mean that you can get a large amount of gain in the future if you wait for some time. Now, between these two extremes, we have balanced investors and growth investors. Balanced investors are those who are willing to take on some market fluctuation, but still they do not have the amount of time in order to for giving an investment to come back or bounce back from its low. Growth investors are more towards the aggressive side. They are the ones who can tolerate market fluctuations, who have a larger, slightly larger time frame with them for investments. And they are more experienced in the financial markets. They know about diversification, they know about capital growth and income. And as you can see from here, from the conservative investor who is willing to take low risk, you can move on to the aggressive investor depending upon what is your profile. Now, one of my friends had suggested that I also talk about age-appropriate risk profile. Anant, this is for you. So here you can see that I have given a matrix which talks about risk profile and the core objectives, but the main focus is on the appropriate age groups. So if you are in your early career, if you are in your 20s or in your 30s, it means that you can take on high risk and you can invest outrightly towards growth products. Your core objective is growth, aggressive growth in your portfolio. If you are in your mid-career, say in your 40s, then your primary objective will be growth, and while you can still take some risk, you do not want to take extreme risks at this point in time. When you are in your late career, say in your 50s, it means that you have to start taking lesser risk and your focus has to move from growth towards income as well. So still your primary, there will be a balance here, balance between growth as well as income. Now, as you hit your retirement, you are in the early stages of retirement. But retirement can be long. It can be 20 years, 30 years, 35 years, depending upon what is your retirement age and what is the life expectancy. So depending on that, your motive is still growth because you want your capital to grow so that it is able to support you for the next 15, 20, 30, 40 years. And you also want income at the same time. So there's a balance between growth and income. Now, last is the option of late retirement. That is people who are in their 70s, 80s or 90s. For them, growth is not a priority anymore. They should not even focus on growth. They have to take very little risk. Their capital should not be impacted at all because they may not have the time for the investment to bounce back from its lows. And their primary objective has to be income. So that is their core objective. So that is about it. And in the next video, I will talk about asset mix. That is, in each of these, what kind of a suitable asset mix will help you form your portfolio. Thank you very much. If you have any questions, you know how to reach me.